Welcome to a presentation of Share plc's 2010 results. My name is Richard Stone and I'm the Finance Director of the Share plc Group. We put out our preliminary results announcement on the 1st of March, and these are some of the highlights. They demonstrate how our revenue growth has translated into increased earnings, underpinned by a strong balance sheet. In addition to the highlights, the Chairman's statement from Sir Martin Jacomb pulled out a number of other key messages from the year. If we go back to 2009, we saw particularly high dealing volumes. In 2010, we saw those high volumes accelerate even further, underpinned by a recovery in market values, which supported our fee revenues. In addition to those points, Sir Martin makes reference to the Financial Services Compensation Scheme levy and its impact on our results. The Financial Services Compensation Scheme is there to support all investors who suffer when firms fail. The costs of those compensation claims are met by others in the industry who abide by the letter and spirit of the regulation. The additional cost for us was £277,000, and that runs from the period of April 2010 to March 2011, and therefore has an impact on our 2010 results. The final point is in relation to the interest rate floor policy, which we took out in November 2007 and expired on the 1st of November 2010. Its expiry meant that we didn't have any benefit in our interest income during November or December. Turning to the numbers, this slide shows our revenue growth of 10.4% to £15.6 million. That was underpinned by strong growth in dealing commission and fee income, which grew by over 18%. In the pie charts on this slide, you can see our revenue mix. We've always maintained a relatively even mix between the three main revenue streams of the business: dealing commission, fees and interest income. However, in 2010, you can see the interest income proportion beginning to be squeezed, partly as a function of the ending of the interest rate protection policy that I mentioned earlier, and partly in reaction to the strong growth in dealing commission and fee income. However, the even split between fees and commission is very different to our peer group, who have more than 70% of their revenue derived from dealing commission. This chart shows our track record of revenue growth over the last 8 years. You can see that we've delivered revenue growth year on year, and that equates to 11% per annum. However, you may be able to detect from the chart that in recent years that growth rate has accelerated, and over the last 2 years was closer to 14% per annum. This doesn't tell the whole picture though. If we look at the numbers behind that revenue, you can see here how interest income has been relatively flat for the last 3 years, in fact falling slightly during 2010 following the end of the protection policy. In 2009 we saw significant growth in dealing commission, as I mentioned earlier, against a backdrop of relatively flat fees. That growth in dealing commission went on further in 2010, but this time was accompanied by strong growth in fee income as market values recovered. In fact, in 2010 our commission and fee income totalled the combined total of all revenues in 2008, and over the last 2 years commission and fee income has grown by over 52%. We measure our share of revenues against a peer group of other execution-only stockbrokers. These include Halifax, Equiniti, TD Waterhouse, Self-Trade, Saga Personal Finance, NatWest and HSBC stockbrokers, Alliance Trust and Barclays. Our market share against these peers has been growing over recent years, and you can see on this chart the progress we've made. Excluding the impact of the interest rate floor policy, our market share in 2010 was 5.62%, which compares to 4.8% back in 2006 when we started measuring this particular statistic. And you can see the impact the interest rate floor policy has had by underpinning our revenues relative to those of our peers who didn't have the benefit of such a policy. Looking at the 2010 performance in particular, you can see on this slide how we performed against that peer group. We managed to grow our dealing commission by 12%, while our peers saw dealing commission fall. Our fee income grew by a similar amount to our peers, whilst on the interest income side we did slightly worse. but overall we grew revenues by just over 10%, whilst our peer group saw revenues decline. Turning to costs, this slide shows where the group spends its money. And you can see approximately half of our spending is on employment-related costs for the some 140 very skilled staff that we employ. In addition to that, about a quarter of our spending goes on marketing, which is an investment in the acquisition of customers for our future growth. The remaining spending, some £4.6 million in 2010, relates to a number of items, in particular direct costs, which relate to the costs of dealing, sending out valuation statements to our customers, other items such as rent and rates, and things such as irrecoverable VAT and the costs of the FSCS levy I mentioned earlier. This next slide shows the relationship between our revenues and operating profit. Back in 2005 we undertook a rebranding exercise, and from that point started to spend approximately £2 million a year on promotional activity. You can see the impact that had on operating profit during 2006, 7 and 8, where operating profit was relatively flat. At the time, we always said that as we started to experience the revenue growth driven by the growth in the customer base, then operating profit would follow along behind. And you can see from this slide how revenue growth has pulled operating profit up and is now delivering strongly. Indeed, in 2010, 62% of our revenue growth translated into profit before tax. Looking at profit before tax specifically, this is made up of operating profit as well as interest on our house cash and dividends from our investments in the London Stock Exchange and Euroclear. Profit after tax divided by the number of shares in issue gives us earnings per share, and here we talk to underlying earnings per share, which takes out the effect of some one-off items such as the Financial Services Compensation Scheme levy this year. You can see the growth in earnings per share that we've delivered in 2010 on this slide. This is partly delivered through the profit growth that I've spoken about already, but also because of the reduction in the number of shares in issue arising from the share buyback that we undertook in August 2010, when we bought back about 10% of the company's shares. Given the strong performance of the group in 2010 and the growth rate of earnings per share, the board has decided to change the dividend policy of the company. You can see from this slide that we've grown dividends by approximately 10% per annum for each of the last 7 years. But in 2010, the proposed final dividend is 20% higher than that for the previous year, at 0.3 pence per share. And in our preliminary results announcement, the board stated that it expected this growth rate to be maintained for the foreseeable future. Finally, turning to the balance sheet, you can see on this slide how the balance sheet is made up primarily of cash and investments that we hold. In 2009, we had a small amount of what's described as other, which related to the interest rate floor policy that we had. In 2010, that's effectively been turned into profit. You can see overall shareholder funds are some £15.5 million, made up of cash and investments, as I said. That equates to about 10.5 pence per share in issue and gives the business a very solid foundation. Looking forward, we continue to experience strong demand from new and existing customers, and given the performance in 2010 and the strong balance sheet, the board believes that the group is well positioned for the future. Thank you very much for watching this presentation. If you have any further questions or would like further information, please go to our website www.shareplc.com. Thank you.